Letting your winning trades run and cutting your losers, it's a trading rule we've all heard. And the idea is to let the trades that are in profit continue to run in order to make as much as the market's willing to give you. With cutting your losses, you're looking to exit the position, preserve your capital when you identify that your losing trade is not preparing to go into profit. So in essence, the trade's just not working. It's an obvious trading rule, and it's one that you think would be easy to follow, but for some reason, traders do the exact opposite when they have an open position. Traders cut their profits and they bank little gains while they let their losers just keep on running, hoping for a rebound. The markets are full of information, and it's not difficult to conjure signals that are supportive of our positions and blank out those that are contradictory when there are none. We all suffer from confirmation bias in one form or another. For many, being right trumps being objective and making money, and we often see traders giving up on a trading plan and just winging it. For some, trading rules are just tough to follow. And day trading runs this risk on more occasions than swing trading due to traders having more trading setups and signals to contend with. If you're a day trader, you must be hyper vigilant to ensure that your trading plan is something that you adhere to, win or lose. And it may appear that we're hardwired to do exactly the wrong thing that will only make finding trading success, which is already difficult to do, virtually impossible. Other traders may be looking at similar things to us and be acting on the same information in a competitive manner. And this can make taking a loss much harder, especially if you hesitate. Looking at a simple but common example, if the market's reached a level where it breaches it, a cascade of orders flow into the market, a missed exit could mean a far worse price if and when you decide to close out your position. So this in turn feeds that first point, and a trader may well just hold on to a trade in the hopes that it's going to come back. And if it does come back and it rewards you with profits, you will never learn that cutting your losses is the best route to go. And that can lead you to trading habits that will eventually destroy you. If you look at trading stats, you'll see why. Your trading stats can be annihilated by just a handful of losing trades or boosted by squeezing a few extra ticks out of every trade or hitting the odd home run. So let's say, for the reasons that we've already talked about, in 2 trades in the set of 30, you just blow out. You take one loss of 6 points, one loss of 12 points, an additional 14 points of loss in total. All other trades are taken as normal. Your average trade now drops to just 0.53 points per trade because of just 2 trades. And this is a fairly conservative scenario of what can happen when traders don't take their stops. So let's now say that you, on 2 trades, you take an additional 3 points. So that's 2 times 3 to add to the total. Your average now jumps to 1.2 points per trade, which is an improved figure. Confidence and emotional balance can be shattered when you lose more than you know you should, and galvanized by taking significant winners. Emotional strength is a depletable resource that's called upon when things aren't going well. So it needs to be built up and nurtured to make sure that you don't lose control. Over time, having the emotional strength and the willpower to continue with your trading plan will help you avoid the big losses and the trading shocks that go with these. So the day trading rule, run your winning trades, cut your losses, is a simple one, but it's far from straightforward to live by in practice. Understanding the absolute importance of this rule is the first step to embracing it. The next step is to ensure that your trade plan isn't ambiguous for taking stops and gives you some room to run the winners. So how do you let winners run? Well, there are several methods to letting the winners run. You can trail your stop. You can scale out to reduce risk, which may let your winners run a little easier. Reduce your risk as price heads to a set profit target, such as a risk multiple or a significant support or resistance level. Hold the position until a technical indicator signal like a moving average crossover tells you to exit. The hard part is having the discipline to actually hold the position while fighting the urge to realize the paper profits. By holding on when the urge to exit that's not based on the reality of the market is where the big winners will come from. Losers need an exit strategy just the same as profitable traders do. The hard part about cutting a losing trade is the hope that the trade will bounce back in your direction. So let's ignore the small moves against your position when you first trigger an entry. It's virtually impossible to pick the exact turning point, so we should expect some adverse price movement. When we're talking about adverse price movement, it comes in different flavors. The low momentum moves against your position, giving consideration that it's not a slow grind against your position, is something that most would just hang on to. But when momentum steps in against you, you should be close to hitting the exits. Forget about hoping the trade will come back, as momentum can lead, and often does, to one more momentum move before price resumes back in the direction of the trend. So the key point in both cutting your losses and letting the profits run is to actually have an exit plan for every position that you take. You could do something as simple as scale out partial positions at 1R and then move the stop to break even. When price continues to move in your favor, use swing points or a moving average to lock in even more profits. While taking the time to test which method of running winners suits your style best, a consistent method of letting this trading rule be a part of your trading is the most important. So just find something and stick with it.